Welcome to Marmor webinar series. I'm Shankar Narayanan, analyst with Marmor. Marmor is a subsidiary of Marcas, Kuwait Financial Center. We cater to the needs of MENA research. Today's webinar is on GCC Economic Themes 2016. We do focus on the major themes for the GCC economies of Saudi Arabia, Kuwait, UAE, and Qatar, and reflect upon the investment implications on the stocks, bonds, real estate, and SME sector, which we think to be the major asset classes and investment focus for the GCC region. Uh, Moving on to Saudi Arabia, the largest economy in GCC, we've identified five major themes, and the first one being energy price reforms. Energy price reforms are being discussed as well as implemented in GCC nations in varying degrees, and Saudi Arabia has also implemented electricity price changes to non-individual users, which has been increased. Though the short-term impact of the energy price increase would be negative, as it would increase the cost of operations for the production sector and also increase the inflation in Saudi Arabia. It would help to rationalize the consumption and improve the efficiency of operations. As we can see, Saudi Arabia has one of the largest expenditure in subsidies as a percentage of GDP, and hence it is very necessary to rationalize the subsidies, and the investment implications of the same would be of varying degrees on each of the asset classes. Uh, Moving on to the next theme, it is of creation of a local debt market in Saudi Arabia, which again applies to most of the GCC countries. In the current low oil price scenario, the GCC countries are in a situation where they need to find alternate source of funding to raise funds to move ahead with the projects that are being planned for the major events such as the World Expo 2020, the major infrastructure projects such as the GCC railways, and the construction activities for FIFA World Cup and so on. Uh, GCC countries as well as Saudi Arabia, they are in a favorable position where they can raise funds through the bond market, as they have a favorable and stable investment grade rating from rating agencies like Moody, S&P, etc. And this will also help them to deepen their financial markets, as they cannot withdraw from their reserves more and more with declining revenues. We expect that in 2016 we can see more of bond market issuances from Saudi Arabia, as with the other countries as well. Though the conventional bond issuances in Saudi Arabia has not been very active in the past, especially in 2011, 12, 13, and 14, when they were generating higher revenues. But in 2015, the Ministry of Saudi Arabia issued bonds worth 30 million, and the same is expected to continue in 2016 as well. The development of the local bond market would have a good impact on the SME sector, real estate sector, and for the bond market itself, as it would create an active secondary market for the country. One of the major reforms that Saudi Arabia is taking is in the front of labor reforms. In Saudi Arabia, we see that the expatriate predominance in labor force has created positives as well as negatives for the economy. In terms of positive, the advantage of low-cost expatriate labor is one of the benefits that the Saudi Arabian companies have been enjoying, apart from the pressure of matching the skill and employment requirement, which has been easier for them with the inflow of expatriates. On the negative front, the government had to bear a lot of burden because of the nationalized employment with increased wages. Uh, However, in 2011, Saudi Arabia decided to implement nationalization of the workforce. It started the Nitakat program, where it aimed to strike a right balance between nationals and expatriates in the workforce. The government hence decided to increase investment for in education sector for nationals, where it increased from 3% in increased by 3% from 2008 to 2014. The nationalization program as a major theme is expected to continue in 2016 as well. However, a rapid nationalization would create imbalances in the work structure. So, gradual nationalization would help to reduce the impact of inflation due to nationalization, and also allow Saudi Arabia to still enjoy the cost advantage by employing the expatriate labor force. The currency peg is one of the highly discussed theme for Saudi Arabia, as it has retained the peg for a long time in the past. With the low oil price scenario and many competing exporters of oil, such as Russia, devaluating its currency, and few other emerging markets currencies such as Brazil, China losing its value, the depegging of currency for Saudi Arabia was also discussed about. However, we do expect that the removal of currency is unlikely for 2016, as the economy is expected to continue to grow at a stable pace, and also the current account balance is expected to return to a surplus. In such a scenario, Saudi Arabia would not depeg the currency or remove the pegging and disturb the trade balances. Foreign investment reforms in Saudi Arabia have started to gain momentum. KSA in the past experienced a decline in FDI, and in the future, with the negative sentiments due to lower oil price, the same trend is expected to continue. However, the reforms that are being implemented would help to smoothen the decline. The two major reforms that were brought about were the reforms in retail sector and opening up of a tadawul for the foreign investors. In terms of reforms in the retail sector, Saudi allowed the 100% foreign participation in single brand retail, which would help to attract foreign players and also help to create job opportunities. In terms of opening up of the tadawul for the foreign investors, it would help to uh, have better stability in the stock markets with more participation of foreign as well as institutional investors. This would also help Saudi move to its emerging markets inclusion in MSCI. Looking at the investment implications of the themes, we see that the energy price reform would have an initial negative impact on the stock market and SME sector, as the prices of the cost of production would increase and would affect the bottom line of the companies. And the effect on bonds and real estate is found to be minimal. In terms of currency peg, the stable and comfortable position that the currency peg offers to foreign investors provides a positive impact on the stock markets as well as bond markets. The labor reforms of nationalization would have negative impacts on stocks, real estate, as well as SMEs, as it would be hard to find the right skill set match, as well as the cost of labor for the nationals would increase, as the minimum wages set for the nationals are high. Creation of local debt market would have a positive impact across the sectors in Saudi Arabia, as an alternate source of funding would be available for the government as well as the corporates, and it would be quite cheaper source compared to the equity raising. Foreign investment reforms are expected to give a thrust to stock markets, as more qualified foreign investors would participate in the sector, as well as a thrust to the real estate markets, as more of single brand retail would help to increase the real estate activity in the country. However, the impact on bonds and SMEs are expected to be minimal. The next major economy in GCC is United Arab Emirates, and one of the major themes for United Arab Emirates is its creation of a diversified and competitive economy. UAE has been a forerunner in policy implementation for diversification of economy from hydrocarbon revenue. Hydrocarbon sector just contributes to 21% of the GDP. IMF has predicted that the revenue loss from this low oil price would be minimal for UAE at 5 to 10%, whereas for other major economies like Kuwait and Saudi Arabia, it is expected to be 20 to 40%. With a stable business environment in place, UAE can foster more of SMEs growth and push towards creation of a knowledge economy, which could be two major areas of focus for UAE in 2016 towards its path of diversification. And it would help to create a more competitive and diversified business environment for UAE. Subsidy rationalization has been a long-standing recommendation from various agencies such as IMF to most of the GCC nations. In subsidy rationalization as well, like other reforms, UAE has been a forerunner. On August 1st, 2015, UAE removed the fuel subsidies, reduced the fuel subsidies, especially on petrol. However, it retained the diesel subsidies to control inflation. The petrol prices in UAE post the subsidy is closer to the national average, which is seen as a very positive step towards the rationalization of subsidies and rationalizing the government expenditure. Water and power tariffs have been increased in the past as well. Abu Dhabi has introduced the multi-slab water and power tariff system as a part of its rationalization on subsidies. This would help to rationalize the consumption of water, electricity, fuel, which are some of the scarce resources, and also it would help to improve the efficiency and functioning of the UAE companies. On the other hand, it would also help to reduce the government's burden on finances at a stage when its revenues are declining and the government is facing pressure. Dubai real estate is one of the most looked upon asset class and a very active real estate market. It has been through ups and downs in the past, and 2013 was a year where the Dubai real estate market performed well. After its boom in 2013, there were fears of bust that cropped up in 2014 and 15. The rapidly increasing rental and sale prices led to the fear that it would lead to another crash in the market. However, Dubai government's intervention with introduction of minimum deposit and increase in land registration fees helped to moderate the effect. As a fallout, the sale prices as well as the rentals went down. Prices fell by 16% for apartments and 14% for villas. Uh, this, coupled with the low oil price and the negative investor sentiment after the prolonged lower prices of oil, had created shockwaves across the stocks, bonds, and SME sector. This is mainly because the real estate sector in Dubai plays a very important role in the economy. Uh, as we have seen, Dubai as well as UAE has been a forerunner in creating a very business-friendly environment. That can be seen through the UAE's rank in ease of doing business ranking published in 2016 by World Bank. UAE stands 31st among GCC 31st, and it's the highest in GCC countries. Globally, in credit availability, it stands 60th, indicating a better position compared to its peers. In the past, it has taken a lot of steps to improve the availability of credit information. It has set up a legal framework for the operation of private credit bureau. There is a law for federal credit bureau inspection, and also exchange of information of utility is possible. We also expect the steps of the UAE government to continue in 2016 to improve the business environment. Some of the steps that we can expect to happen is creation of one-stop shop for approvals, the increasing use of technology that is being done in countries like Singapore and Hong Kong, and improving the credit information that is available. One area of focus for UAE would be reducing the compliance cost for exports and imports. The cost of compliance for exports and imports is around $200 higher than the MENA average. With a good business environment set up, it is no doubt that UAE is a leader in the SME sector. 92% of the companies in UAE come from the SME sector, and they contribute to 60% of UAE's non-oil GDP. The government has a vision for 2021 whereby it sees to increase the SME's contribution to the non-oil GDP by 70%. Dubai SME 100 is a flagship program that was launched in 2011, and it aims to identify top SMEs and provide them governmental supports. The low banking support for SMEs in the region is one impeding factor for the growth of SMEs. However, UAE and Dubai, with its better focus on the SME sector, can be expected to provide more thrust for the sector in the future as well. Creation of a local debt market in UAE as for the other GCC economies is expected to happen with declining revenues for the government as well as the private sector. In 2015, there were 26 bond issues, out of which 24 were from the corporate sector. Um, Currently, the firms rely heavily on bank loans. However, with Basel III norms being implemented and to be and expected to be completed by 2018, we expect that the amount that will be available for lending would reduce, and the corporates would resort to bond markets. With the stable ratings, it is expected that the UAE markets can deepen in 2016. However, the public debt law, which is stuck in the consultative process needs to be uh, hastened and implemented. Coming to the investment implications of the various themes, the diversified and competitive economy that's created in UAE is a positive for all sectors, though its impact on real estate could be minimal. The diversified economy has helped the stock markets in UAE sustain minimal loss despite the rapid fall in oil revenue. It has already deepened the bond market to some extent compared to its GCC peers. And as we have seen, the SME sector has well developed in UAE compared to other markets. Creation of a local debt market would be beneficial to the bond markets, the real estate sector, and the SMEs, especially for the real estate and SMEs, as they could find an alternate source of funding at a cheaper cost. The weakening of the Dubai real estate markets is a negative factor for the stocks, bonds, as well as the SME sector. Uh, the Dubai as well as Abu Dhabi markets have a huge constituent of real estate stocks, which are weakening in the past. The real estate companies that resort to raising bonds in the market have uh, gone for lesser issues with lower projects. And in Dubai, 33% of the SMEs operate with housing, real estate, and rental sector, all of which have lost some business due to the fall in Dubai real estate market. The subsidy rationalization is expected to have a negative impact on the stocks as well as SMEs, as the companies will have their bottom line affected with the higher cost of operations. The improving of business environment and creation of a leadership position for the SMEs in UAE is expected to have positive impact across all sectors, as it would help to improve business, it would help in diversification, it would help the UAE business to become more competitive in the global world. The next major economy that we would be focusing on would be Kuwait. Introduction of taxes, as with subsidies, has been a long standing recommendation from various agencies. Taxes in Kuwait are currently low, and introduction of both direct as well as indirect taxes have been recommended by IMF and other agencies such as OECD. However, the tax laws that taxes that have been implemented in the past have not received much of appreciation, and in certain cases they have been rolled back. The recommendation from IMF is to implement a 10% tax rate on corporate profits, and also to implement a VAT in Kuwait as well as in other GCC countries, as it would be simpler to operate and an efficient means to collect. For 2016, the implementation of taxes in Kuwait is, however, not seen to happen. For subsidy rationalization, as recommended for other GCC countries, it is very much a necessary step that the Kuwait government has to take, as the prices of petrol and electricity have remained unchanged for nearly 50 years and are very low when compared to GCC peers. The wages subsidy are also high for Kuwait government, as 85% of the national population are employed in the government sectors. Water and power tariffs have to be increased, and Kuwait has to capitalize on this low price scenario to reduce its expenditure by reducing subsidies. Subsidies must not be seen as a way to distribute wealth. Alternate ways such as cash transfers must be explored upon. Kuwait must also make use of the lowest break-even oil price that it has when compared to other GCC nations. For instance, Saudi Arabia has a break-even oil price of 95.8 USD per barrel, whereas Kuwait just has 51.8% per barrel, where the losses that it would sustain from the low oil price would be minimum for Kuwait. Uh, though it heavily depends on the hydrocarbon revenue for its economic activities, it must take advantage of this low oil price situation and fast track its reforms such as subsidy rationalization, and fast track the implementation of the Kuwait development plan. Creation of a local debt market. uh, as discussed for UAE as well as for Saudi Arabia, is a necessary alternate source of funding that would be required in such a scenario where there is less amount to be funded by the banks as well as by the government. Kuwait can resort to bond markets as they have a very stable credit rating, and incorporating debt would also help to instill disciplined spending by the corporates as well as the government. Accelerated implementation of the Kuwait Development Plan. Kuwait Development Plan is a series of 5-year plans that aims to transform Kuwait into a regional financial and commercial hub. It was started in 2010 with the focus more on government-led infrastructure development. The assessment of the plan in 2014 has revealed that only 59% of the actual budget has been spent, and the plan has not succeeded as it was aimed for. In 2015, a redesigned plan has more private sector led diversification, and the overall budget for the plan is KD 34.15 billion. The implementation of long stalled mega strategic projects would also help Kuwait to achieve its aim in Vision 2030. For the accelerated implementation of KDP as well as diversification, proper business environment is necessary for increasing the private sector driven growth. However, fares poorly in the rankings and it's the lowest among GCC countries. Land reforms have to be uh, implemented for making it easy for licensing plots for entrepreneurs. Kuwait needs to make reforms in terms of removal of paid up capital, having one stop shop for approvals, allowing foreign ownerships and joint ventures, and also implementing land reforms that would help the private sector. Looking at the investment implications, the lowest break-even oil price is will have good impact on the stock and SME sector as the losses that they would sustain would be minimum. However, for the bond markets, it is expected to have a negative impact as the necessity for fundraising would be less. Um, the creation of a local debt market would have positive impact on the bonds, real estate, as well as SME sector, as it would provide a cheap and alternate source of funding. Introduction of taxes would have a negative impact on stocks, real estate, and the SME sector, as the companies which are not used to paying taxes would have to make provisions as well as pay a higher amount and have a lower bottom line at a stage where their revenues are already dwindling. Subsidy rationalization, as for the other GCC economies, will have negative impact on stocks and SMEs, however, have a positive impact on the bond sector. Though these negative impact on stocks and SMEs will be in the short term, in the long term, it will help to rationalize the spending of the government and also improve the efficiency. The accelerated implementation of the Kuwait Development Plan and improving the business environment would have a positive impact on all these sectors as diversified economy with better revenue generation and better efficient operating business would have positive impact on all these sectors. Moving on to Qatar, one of the major themes that we could see for Qatar is the budget cut that is being discussed upon. Though the exact amount of the reduction in the budgets is not known, we can see that the government's revenue has declined by 30.2% in the low oil price scenario in last year, and the expenditures are expected to decline by 7.28% in Qatar. Projects, especially in the oil sector, are expected to get delayed. However, the major projects for in the construction sector and other major infrastructure projects planned for the FIFA World Cup could not be stopped. So Qatar might have to resort to borrowings and debt financing to bridge the deficit. The liquidity crunch is expected to lead to more number of bond issuances. Qatar's central bank has been the largest issuer of bonds, which has accounted for 42% of the issuances from 2011. Qatar's very stable sovereign rating of AA2 with from Moody's has helped to maintain the bond issuances from in the past. The Qatari government is expected to conclude $1 million sovereign issue in early 2016, which will help to finance their projects as well as deepen the bond markets. Subsidy rationalization and tax reforms are very important for Qatar as it is one of the largest energy consumer per capita in the world. Energy consumption in Qatar is heavily subsidized for the nationals, and hence it leads to irrational consumption of power, water, and fuel. Though there are recent measures being taken by Karama in terms of tariff hikes as well as introduction of multi-slab systems, uh, the reforms need to be fastened and implemented quickly in order to reduce the subsidies in Qatar. In terms of taxation, Qatar currently imposes only corporate taxes. However, more number of direct and indirect taxes are recommended to be implemented, and VAT is seen as an ideal source of revenue for Qatar. Improving the business environment becomes very important for Qatar to progress, as Qatar stands 68th and fares poorly among the high income countries. It has taken few steps in terms of liberalizing the starting of business and reducing the number of government interfaces. However, steps need to be taken in terms of providing construction permits, providing electricity, as well as um, removing the number of hurdles in terms of exports and imports to improve the operation of business in Qatar. Qatar has placed emphasis and focus on the SME sector, though it has not achieved a leadership position as with UAE, mainly due to its low banking support. The banking support provided to the SMEs in Qatar is the lowest among GCC countries at 0.5%. Since Qatar government has recently launched a dollar 27.4 million Qatar Business Incubation Center, making it the third largest incubator in the region. Creation of SME exchange and encouraging the private equity and venture capitalists in the market would be the need of the hour for Qatar to improve its SME market and create a leadership position for itself in the coming years. Looking on to the investment implications, the budget cuts would have a negative impact on stock and real estate markets, as spendings would reduce and projects would go down, and the stock markets would have a negative investor feeling. In terms of the real estate sector, it is expected to have a negative impact as projects which are already planned might get stalled. In terms of the investment implications on bonds and SMEs, it is expected to have a positive impact as bonds would be resorted for an as an additional source of funding, and as Qatar government plans to uh, facilitate the improvement of SMEs in the country, we expect that though the budget cuts would have negative impact on stock market, it would not have that negative impact on the SME sector. The borrowings and development of debt market would help to have positive impact on the bonds, deepen the bond market in the country, and also provide the mega projects planned in the real estate sector with an additional source of financing, though its impact on stocks and SME sector would be minimal. Subsidy and tax reforms, as we have seen for the other countries, would have an initial negative impact on stocks and SME sector. Improving the SME sector in Qatar is necessary, and it would provide a positive impact on bonds, real estate, as well as the SME sector, as SMEs would resort to bond financing, and also more of in construction activity in the real estate sector could seem to happen. We come to the end of the presentation. Thank you for joining us. Any questions would be addressed. We have a question on how the reform efforts in Kuwait can help in implementing KDP. In terms of reforms to help KDP, we can first focus on the reforms in the SME sector. Kuwait, compared to the other GCC countries like UAE or Qatar, has not much focused on SMEs and its development. Uh, and again, Kuwait must focus on improving the ease of doing business in the country in terms of construction permits, in terms of giving electricity connections, as well as creating a one-stop shop for approval and bringing down the delays. Subsidy reforms, tax reforms, and as well as increasing the foreign ownership, joint ventures, public-private partnerships, all could be reforms that can help in achieving KDP, a success KDP, and its vision in 2030. Uh, Another question from another participant is how far the corporate earnings would be affected in the coming year. In terms of corporate earnings, it would vary from sector to sector. For sectors which are already dependent on oil revenue and uh, for sectors that have oil as the raw material, the subsidy rationalization would be a big game changer as it could see declining revenues. For sectors such as banking and services, though they would see a decline in revenues, the impact of subsidy rationalization or other reforms would be minimal. Another question on will the removal of subsidies impact the inflation in GCC countries? Yes, to some extent, the removal of subsidies would impact the inflation. Even in Saudi Arabia, for instance, it is expected that a 10% uh, increase in rates of fuel would lead to 2% increase in inflation, a 0.2% increase in inflation. The same applies to other GCC countries as well. However, in the long term, it is seen that the subsidy rationalization would normalize its effect on inflation as well. In terms of the investment impact in the low oil price scenario, it is expected to be different across different sectors and different countries. For instance, for the Dubai real estate market, it has created a huge negative impact, and hence on the to some extent on the stock markets and SME sector. However, with the opening up of Tadawul exchange and foreign partnerships in KSA, there has been a positive impact on single brand retail as well as on the KSA stock markets and so on. However, on a wide perspective, the low oil price scenario has created a negative investor sentiment. We come to the close of the webinar. We would be sending a copy of the recording to you by your email in a day or two. Any questions can also be addressed to snarayanan@marcus.com. Thank you for attending the webinar.